This content should not be construed as financial or investment advice. I am simply sharing my personal views and perspectives, which I hope will educate and inform and help give you the confidence to make your own financial decisions. If you need financial investment advice, please seek in-person advice from a qualified, experienced, and regulated finance professional. YouTube will not save you.
Elon is many things right. Some great and really impressive, some pretty bad. But right at the top of that list, Elon is petty. Within this document are 17 mentions to a new agentic AI company. What do you think he's called it? Bill Gates is Microsoft, and Elon claims to be... This guy is not serious. He's asking for his company to be worth trillions potentially, and in the official documents, he's making dick jokes.
Hello. So at the time of recording, and this is around June 2026, we are anticipating potentially one of the biggest IPOs we have seen in quite some time, potentially in history, actually. And this is the IPO of SpaceX, which is anticipated to make Elon Musk a trillionaire, potentially. And this is his business, which he's looking to basically terraform, I suppose, Mars and create a permanent settlement in Mars at some point in the future. So there has been some controversies and concerns around the circumstances surrounding this IPO, that it's not following the normal rules, which is something Damien Talks Money is going to talk about, but also the actual valuation itself, which another massive YouTube content creator called Patrick Boyle has also covered in a lot of detail, and his video is very thorough. It's an excellent video, and I will leave a link to that particular video in the comments, which I definitely recommend you watch, which goes and dives into this IPO and the circumstances in quite a lot of detail, but it's very entertaining and very enjoyable, which is why I'm recommending that particular video by Patrick Boyle. So I wanted to cover this particular YouTube content creator. I believe his name is Damien, and I think the channel's called Damien Talk Money. Again, I'll leave links and a fact check in the actual video. And this is somebody, again, I really respect in terms of the financial advice he provides. He has a massive channel, which obviously adds credibility to a lot of what he says, because obviously a lot of other people buy into you know, the kind of advice and content he creates. So I would consider him a reliable source in terms of what he's going to cover here. And essentially, you know, I think it is useful to understand the dynamics of what is going on and how it may potentially affect investment decisions we're making, and how it can ultimately affect how we view business and wealth creation, actually, in terms of the wider context and the wider conversation we're having around wealth, how it's being created, accumulated, or concentrated, as I would say. I wouldn't consider wealth as something that is created. I would consider it as something that is transferred from one party to another. So yeah, I think this will be a good video to dive into. So let's get stuck in and see what we can learn.
There is genuine concern right now that index fund investors are about to be screwed.
So if you're wondering what an index fund is, the easiest way to think about an index fund, it's a particular investment instrument, let's call it, or vehicle or product that is created to allow you to invest in lots and lots and lots of different companies, essentially. And these funds will focus on particular markets, which Damien will go on to talk about during this video. So just basically think of it as an instrument or a product that allows you, with a small amount of money, a small amount of capital, to have exposure to lots and lots and lots of different companies. And the idea basically is that it creates a very safe product because there's natural hedges. I mean, depending on what you're trying to do, you can have different makeups of companies, but ultimately they're considered safe, essentially. And this is why they're appealing to many, let's call them retail investors. That is the term. But what I mean by that, it's casual investors, people that are not picking stocks and that don't have a particular investment strategy. They just want to participate in overall market performance, essentially.
Over the coming months, some of the biggest private companies in history could come to the stock market. SpaceX, OpenAI, Anthropic, many of these companies.
Notice the companies, right? There's a theme here. SpaceX actually does have an AI division, right? So this is basically AI as well as SpaceX. And arguably, these are areas where there is a massive concern around, obviously, the bubble.
And at the same time, behind the scenes, the people who put together the funds that we all buy are changing their own rules to allow these companies into those investments quicker. Why? Are index fund investors being used by these companies to cash out?
Yeah, and the question he asked there about why are the rules being changed? So again, he hasn't really talked about the rules that were changed. And I think that's why I've referenced the Patrick Boyle video, because the Patrick Boyle video talks through the circumstances as to how this is happening and the shortcuts that have been allowed to enable the IPO and to facilitate the IPO. And I think in the very simplistic terms, and a very simplistic way of thinking about this, when he asked the question why, is consider the relationship between the owners of these companies and Donald Trump, right? So this is not about taking a conspiratorial approach to all of this, but the optics are not very, very good, right? It seems as though through lobbying, through influence, through proximity to Donald Trump, you know, at least Damien and Patrick Boyle, two prominent YouTubers, are questioning the circumstances of this IPO and seeing there's a difference between a more conventional approach that other businesses have had to go through to do or, you know, complete an IPO, right? So it's something worth taking note of. And I think for me, it ties back to the wider concerns we have around where you have this massive wealth already and you have this proximity to decision makers, to legislators, and in this case, Donald Trump. You can create an environment where you have an advantage to, you know, compound that wealth, compound that power over and above what normal business entrepreneurs and individuals may have, right? So I think for me, all of these things come into play in my mind when thinking about the wider context of what is going on and the question Damien is asking here.
Leaving us holding some very heavy bags.
This is the biggest IPO of all time.
We're looking at $2 trillion in valuation.
Right, what is going on here? So if you're like me, you're an index fund investor, you might sit there and think, well, I just buy the market. But what you're actually buying is a list of companies chosen by an index provider.
Yeah, and I think for me, to keep it very, very simple, you're buying a product, right? Because you're not picking the stocks, right? So when you buy an index fund, normally the decision you're going to make is, okay, how has that fund performed in the past? And that will give you an indication about how well the product is being curated, right? So basically stocks will fall in and out of that product because whoever is managing that fund or creating that product or looking to sell that product wants that product to keep giving an over and above market return, right? So I think in my mind, it's probably easier just to think of it as a product you're buying rather than directly investing in the market yourself.
So S&P Global, most famous for their S&P 500 index, the top 500 companies in America. FTSE Russell, they're famous for things like the FTSE All World and the FTSE 100. MSCI, probably most famous for its MSCI World Index. And then NASDAQ, probably known best for the NASDAQ 100, but they're also an exchange, which is important in this conversation that we're going to have. But to start off with, the thing that's important to understand is the market is not some natural law, some observable truth. It's what these companies say it is. And these companies are not charities either. Their indexes are products. When you or me invests into a fund that tracks one of these guys' indexes, one of their lists, a little slice of the fees that you're charged goes to these guys.
Yeah, and that's why, again, he used the word products, and I would view these as products, right? You know, how you value these products will be based on the returns they're offering. And obviously in return for that, because they're providing a service, they're providing a product, they're going to take a fee for doing so, right? So you can pick these stocks yourself if you like, or you can leave it to these product providers who will then select a suite of companies and their stocks to use to pull together and collectively create the product they're selling to you. And then through buying the product, you're basically buying a fraction of all these different companies and all their stocks, essentially.
So why are these mega IPOs making some very credible people pretty nervous? We're going to focus on SpaceX to answer that, because they're going to be the first to list on the stock market, and because we've got this incredible document. It's the SEC filing for SpaceX that basically explains the investment opportunity. Normally these things are pretty boring, but this is just pure cinema. Just before we get into the numbers, let me show you this first of all. So a little backstory. It's rumored that Elon Musk doesn't get on with Bill Gates, founder of Microsoft. The PG-13 official stance is that Elon was annoyed with Bill Gates because he bought a Porsche instead of a Tesla. Is it Porsche? Is it Porsche? I don't know. Have a go at me in the comments about it. It was also rumored that Bill Gates shorted Tesla's stock price, so bet on it to go down. But there's another bit more seedy version to this story that I'm going to tread around carefully so I don't get sued. Within the Epstein files, there was an email from Elon. And I quote, "What day/night will be the wildest party on your island?" So there's rumours online, definitely not said by me, all this is just allegedly, that Bill Gates blocked Elon Musk from going to the party.
Why is Epstein's footprint everywhere, right? And again, it comes back to what I was talking about in terms of, again, you're trying not to be too conspiratorial, but these connections between all of these individuals and what it means in terms of, something like an IPO and how it influences that, right? So again, this to me just shows you or illustrates, this sort of incestuous nature of their connections at the very, very top. The financial elites. It is just this sort of entanglement, this entangled arrangement they all have with each other. To keep themselves, they just live in a completely different space, a completely different bubble. And they're in a position where they have privilege in terms of their influence over lawmakers and the leader of the free world.
Elon is many things right. Some great and really impressive, some pretty bad. But right at the top of that list, Elon is petty. Within this document are 17 mentions to a new agentic AI company. What do you think he's called it? Bill Gates is Microsoft, and Elon claims to be macro hard. This guy is not serious. He's asking for his company to be worth trillions potentially, and in the official documents, he's making dick jokes. That might concern some investors about putting their money in such a business. But actually what's got people pretty concerned is the numbers. Many of you probably think of SpaceX as a rocket launching company, but Elon's actually putting this business forward as many things. Rocket launching, asteroid mining, Mars inhabiting, social media, internet provider that also has an AI business and a space AI business, and a data center business, and of course, a space AI data center business. With all this cutting edge space AI capability, you'd have thought they'd have run this document through an AI to check the punctuation at least, but seems not. Combine all of these businesses and ideas together, and SpaceX claims that its total addressable market is $28.5 trillion.
Yeah, and I think for me, the reason why this is being viewed quite cynically is because it looks like you're inflating the addressable market, right? If you say your company is an everything company, right? So Twitter, or X as it's now called, he wanted to change it from a social app to an everything app. And I think there is an app like this in China that is doing really, really well. I can't remember what the app is called. And again, it seems like he's taking this same approach with SpaceX. When most of us think of SpaceX, we think of it as a space company, right? Whereby it's going, its mission ultimately is to get to Mars and maybe some other things, right? But space related. However, if you say it's a internet provider, I mean, you can see it all listed down there, right? If you say it's an AI company, if you say it's a SpaceX company, then it becomes an everything company, right? And then therefore the addressable market theoretically gets bigger and bigger and bigger. But one has to question then, is SpaceX is doing all of these things? Is it cannibalizing it, its other group companies that Elon Musk owns, right? Is it encroaching on some of those things? And that's the problem with Elon Musk and his business approach. He has a business, say like Tesla, for example. He'll then create new businesses that will do things that actually compete with other businesses he owns. And this is something Patrick Boyle, who I referred to at the beginning of this video, talks about, right? Again, very eloquently. So this is why it's difficult for, people like myself, and I guess this is why Damien also has some concerns, which is why he's made his video, to take Elon Musk seriously. And if you're a company that is looking at, a valuation, I think he said 2 trillion, and it's going to be part of indirectly our investment portfolios, if we are buying index funds, then how do we feel about that, right? So that's why it's concerning, right? That's the context of what is going on here.
TAM, or total addressable market, is the size of the opportunity that a business potentially has available to it. So if I was an ice cream salesman in a park and 1,000 people came to the park every day, my TAM amount of customers, my total addressable market, would be 1,000 customers. Doesn't mean I'm going to sell to them all. It's just what potentially is the size of the opportunity. So they think 28.5 trillion is the size of the potential market. And look, space and AI and social media and all of that is pretty big market, right? But just to put that into context, 28.5 trillion, the total size of the food market, the total addressable market that is food, so every single thing that we eat on planet Earth, is about 10 trillion a year. Elon's out here saying that he's going to be 3 times bigger than food. So go on then, Elon, show us the money, mate. In 2025, SpaceX had revenue of 18.674 billion and a net loss of 4.93 billion. If this company comes to the stock market at anywhere near the rumored 2 trillion price point, any way you slice it, the valuation is insane.
Yeah, so although it has an accounting loss, that in itself doesn't potentially undermine the valuation. I think for me, the problem I have with the valuation is the point he raised around the total addressable market and the comparison he gave to the food total addressable market, which is an essential, thing we need, which we have no choice but to buy. So for me, that's what doesn't make sense, because, we all understand that markets are finite, right? Available capital is finite, available spending power of workers or businesses that might be looking to buy these products that he's looking, that's the market he's looking to address potentially. They only have so much cash, they only have so much resources, right? So how do we justify the valuation on that basis, right? But the revenue and accounting loss on its own, for me, doesn't tell you much, right? Right. That's the key thing I want to make at this stage, right? So it's just something to consider. It does feel very outlandish, when you compare it superficially, but there are many, many loss-making businesses that will see very, very high valuations, right? Despite the fact they're loss-making. That in itself is not unusual.
Its price to sales ratio is between 93 and 107, depending on how you value it. For context, the average S&P 500 company is around 3.6 times. Palantir, often called overvalued, is around 67 times. And Meta and Alphabet, which people worry is in a bubble, are around 7 to 12 times. I don't know, maybe this business delivers on everything that it promises.
Yeah, so basically what I would take from that, and again, I think this also is a credible point in terms of where the cynicism may lie, is that this is clearly an outlier, right? So what is important with these kind of analysis that he's doing, and it's very good analysis, is that you test it against their competitors, right? And you see where they line in the industry. So if your metric, if your price to sale ratio is way out of kilter from what everybody else that would be considered a comparable company is doing, then clearly we have to look at that valuation cynically, unless the prospectus can basically clarify what makes this opportunity so unique. Because essentially what you're describing with respect to the valuation and what's being implied is that you're going to essentially have a monopoly, right? You're going to have first mover advantage. And as a result of that, you're going to have a monopoly, right? And I think for me, that might be the case, but is that something you can rely on comfortably and be confident about that? Or would that be in the realms of extreme optimism, right? And bullishness, right? So that for me is why, we have to look at those ratios very, very cynically.
This document boldly goes where no man's gone before, but it's being priced in a way like that future has already happened.
Exactly. That's the point, right? So nothing is impossible, right? Even if it seems ridiculous, even if it seems unlikely. But should we pay the premium for something that hasn't happened? And it seems like, if I'm being honest, many of these tech companies, certainly Elon Musk companies, they price things as though they've already happened, right? And for me, how I feel about that, I'm not sure, right? My feeling is probably aligned with Damien here, the content creator, in terms of saying, okay, I don't buy into it. It's not. I just naturally wouldn't. Until something has been delivered, I'm not going to assume it's been delivered. Is essentially where I'm coming from, and I wouldn't be prepared to pay a price based on a promise of tomorrow, right? Because when tomorrow comes, the price will be even higher still, right? So whatever price it is now, that is the accepted valuation you're taking for what it is right now. Because when it becomes the thing it's saying it's going to become, the price will be even higher still. Theoretically, right?
But I think one of Elon's biggest strengths, or one of the skills that's right at the top of that list of things he's good at, is selling his idea of the future and then convincing people to give him a lot of money to go chase it. Even one of the more solid claims of revenue in this, like Anthropic paying SpaceX 1.25 billion a month, that deal can apparently be cancelled with just 90 days notice. And this is what matters for investors. The worry is here that Elon and all these other mega IPOs, so Anthropic, OpenAI, SpaceX in this example, are using the stock market to basically cash themselves out and early investors. That they're putting companies onto the stock market with massive valuations without the numbers behind it to back it up.
And what I'm thinking is this is exactly the criticism of crypto. So again, this is a wild tangent I'm making. This is nothing to do with crypto, but this is exactly the model that's being argued, right? Whereby you have this inflated, massive valuation of a product, of a token, of a crypto asset. All the early investors cash out, and the founder maybe cashes out, and then everybody else is squabbling to mitigate their losses as a result, right? So for me, this is what it feels like. And to be honest, in many ways, many businesses are set up in this way, right? Many legitimate businesses are set up in this way where they want to initially, during the early rounds, whether that be, the early rounds of investments or the final IPO, to immediately reward the founder, staff that were there as part of the founding community, as well as the earliest investors that took a massive risk, right? So in some ways it is normal, this arrangement, but in the context of what is being discussed here, and also this prevailing feeling that AI is a bubble. There are questions about how effective and useful AI actually is at the moment, outside of just producing a lot of slop. And yeah, the fact that, again, when you look at the prospectus, it looks like it's deliberately inflating the company's value by inflating, for example, the total addressable market, by presenting itself as a company that can just basically do everything, despite the fact that some of the contracts it actually has are not long-term contracts, as he outlined there. If you have a contract which can be cancelled, after with 90 days notice, is that something you can rely on, right? And how would an investor, as he says, look at that contract, right? They wouldn't feel comfortable that arrangement is a very long-term arrangement, right? So that is why, again, it feels to me almost like a rug pull of sorts, right? And that's why it's making me think of the criticisms crypto has received in recent years.
If you want to buy the individual stock, fine. That is the stock picking game. I personally wouldn't touch this with a barge pole myself. Not because of anything that we've discussed today. I just have a rule that I don't buy IPOs in and around launch. I think that the main reason that companies are brought to market is to cash out early investors.
He's right, and I would agree with him. And I actually have a similar approach. Now, to be very, very clear, this is not investment advice. He is not giving investment advice. Again, he's someone I really respect, and he's very, very clear about the fact that despite the fact he is a qualified financial advisor, he does not offer financial advice through a YouTube video. And no one that is credible will do that. And I'm not a qualified financial advisor, and I am not offering financial advice in any capacity, whether it be in person or through this video. But what I am saying is that his approach is sensible to me, right? And it's a similar approach I have because, as I say, and as I've said, part of the IPO is to reward early investors, right? They have invested at an early risky stage with the intention of cashing out, right? That was the reason. In the same way, if you sell your business at a certain point in time, maybe you're looking to retire, you're cashing out. You know, the reason you did the work was so that you could cash out, right? And then somebody else is willing to buy on that basis. Now, it's not a given the IPO is going to be fully subscribed, actually, right? So at the end of the day, that's the other thing to consider. So if they are able to cash out, arguably they've done a good job. They've convinced enough people that they've done a good job. But if they can't cash out because there isn't a full subscription of the IPO, well, then they don't get to cash out as much as they thought, right? So the point is that there's a lot of sentiment going on around the time of an IPO. And that could mean it's overinflated, but it also could mean that it's at a discount and you made a good decision, right? So you've just got to make your own decision about all of this. But if you are someone who is more conservative, if you are somebody that is a value investor, if you are somebody that looks at passive investment, i.e. you're looking to buy index funds, which is the type of investor he is describing himself as, then it would be consistent with that philosophy that you wouldn't jump in on an IPO, certainly with something whereby it feels like it's part of a wider financial bubble.
If you buy SpaceX on launch, that's totally up to you. Just understand what you're getting yourself into. And look, I'm not going to sit here and say it will be a bad investment.
And yeah, it could be the most amazing investment anyone has ever made, right? That's not what is being communicated here, right? All it depends on is your own investment philosophy, right? And whether or not, you know, you just want to back Elon Musk, actually. So yeah, just do as you please. Just make sure you're informed.
But the worry in here for the index fund investors, and this is what we're focusing on today, is that actually these businesses are potentially overvalued, and there are index providers that are changing their rules in order to get these companies to market quicker. And if these companies enter into the index, well, then index fund investors aren't choosing to buy this business, they're forced to buy it. And that's exactly what we're seeing happening at the moment ahead of this launch. I found examples across 3 of the providers of recent rule changes. And there are 4 main ways an index changes the rules from what I can see. I'll run you through a couple, explain what they're doing, and then show you how big of a deal this is to investors. The first rule change relates to timing. So how quickly can a company get into an index? Many of these providers have what are called seasoning periods. So you have to have been on the stock market for so long before they'll let you in.
And the whole point of a seasoning period, or I suspect a large reason for a seasoning period, is due diligence, right? So if you're bypassing that approach because you're pushing the IPO and allowing participation a lot quicker than you otherwise would, firstly, it's unfair to other people that are looking to do an IPO. But secondly, does it undermine anything around due diligence, right? And the valuation, funnily enough, you know, so it makes it harder to vet a company before, you know, and make sure it's IPO worthy, essentially. So for me, that is why this point is important, right? This seasoning period to me is really, really important. And it should be the same for everybody, would be my view, regardless of their relationship with the leader of the free world.
It just lets a company breathe a little bit on the open market, lets the market establish and judge how much is this company actually worth. But in March this year, NASDAQ announced a new fast entry rule, effective from the 1st of May, that made it so a new company, which usually had to wait 3 months before joining the NASDAQ 100 index, can qualify after just 15 trading days.
And again, the reason why this is important is who does that benefit, right? A lot of these rules are there to protect the consumer. And as I say, if you think of these index funds as a product, we are the consumer, the retail investor, the unsophisticated, uneducated investor. In many ways, often they tell us we need protection from ourselves, right? Certainly when you think again, crypto regulation, we are told, we need to make sure there's proper regulation in place to protect our, the retail investor. When you think about GameStop and what was going on there, when they were, there was that short squeeze. Again, all the platforms colluded to stop people buying the shares in an effort to protect the retail investor from themselves. So, on the one hand, it's like all of these things should be in place to protect the retail investor. However, in this instance, what we're finding is that the seasoning period is being removed and the rules are being changed, arguably and definitely actually for the benefit of the person looking to go through the IPO, in this case, SpaceX, but to the detriment of the retail investor, because we haven't had that time to really get any gauge around the true sentiment of the valuation of that business. And what I mean by sentiment is essentially demand, right? If you put it on the market for 3 months, we won't know its valuation, but we will get a sense of the demand over that period of time, right? And that seems to be curtailed as a result of what we're seeing here.
That gives SpaceX a much faster route into the NASDAQ index. But crucially, these other providers, they have their own waiting periods. Remember, the market is not just one thing. It's what these providers say it is.
And the reason he says it is what these providers say it is because they're directing all of our collective capital. Because when we buy these products, we're putting capital in and we're giving it to these index fund managers, let's call them, or providers. And they're deciding where it goes, right? And depending on where that goes, it drives demand up for that particular stock and therefore drives up its price, right? So that is why he's saying they are deciding the markets, right?
Take S&P Global's S&P 500 as an example. If SpaceX listed at around $2 trillion, it would be one of the biggest companies in America. Fairly gangster that Elon has 2 of the top 10. But anyway, that size alone doesn't get it into the S&P 500, which is the top 500 companies. They have a 12-month wait period. They are in the process of trying to cut that down to 6. But even then, SpaceX likely wouldn't enter the S&P 500 until around March or mid-2027. FTSE Russell is changing its rules in a similar way to NASDAQ. For the Russell 1000 and Russell 3000 indexes that track the top 1000 and 3000 companies in America. So if a new company is big enough to sit in the top 500 of those indexes, it can enter after just 5 trading days. The second rule change is free float. So how much of a company is actually available to buy on the stock market? If my business is worth £1, but I only list half of it on the stock market, well, only 50p is floating around the free float for investors to buy. Most big US companies have huge floats, but SpaceX could be very different. If it raises between 50 and 75 billion at a near 2 trillion valuation, only around 2 to 5% of the company may be listed on the stock market. So investors will be buying a tiny slice of this business, just the tip. I think that's a great way for SpaceX to create scarcity around its shares, and also for Elon to keep very much all of this company in his control. But normally, small free floats make index inclusion harder. So, of course, the rules are changing. The NASDAQ 100 used to require at least 10% of a company's shares to be free floating. That threshold has been reduced, meaning SpaceX could qualify even if less than 5% of the company is actually on the market. FTSE Russell is changing this too, for global indexes as well, not just the Russell 1000 and 3000. So this affects the funds that I actually buy. And you know what? I had to properly dig to find this information. The rule is much simpler than all this jargon makes it sound. If a company is expected to exceed a 5% free float, so 5% of it's available on the market within 12 months of listing, it can qualify to go into the index. SpaceX might only list with, say, 2% free float, but once insiders pass their lockup periods and they can sell some of their shares that they got before the IPO, that float could rise. So it probably qualifies under these rules quite quickly. But before anyone panic sells their index funds, I think a lot of the chat online around this is missing some key detail. I think one of the key details that's not being discussed enough is weighting. So how big would SpaceX actually be in the index? In the past, the NASDAQ 100 would treat a company as if the whole thing was available to buy, even when only a small slice of it was actually floating on the stock market. You would have 10% of your company on the market, and the NASDAQ 100 would put it in the index like it was 100% available. Now they use a free float multiplier. That's what I'm calling it. So if SpaceX listed at around 2 trillion with only 5% of the company floating, NASDAQ would treat it more like a $300 billion company, not a $2 trillion company. So that means analysts estimate that SpaceX could be around 0.47 to 0.7% of the NASDAQ 100. For every £1 you put into that index, less than a penny goes to SpaceX, compared with roughly 7p to Apple. FTSE Russell is even stricter. No multiplier, just the free float. So if only 5% is listed, only 5% counts. That would mean that SpaceX is going to be under 0.2% of the Russell indexes that we discussed before. SpaceX is not about to become 10% of your portfolio if you're invested in one of these indexes. I think that detail is missing from a lot of the chat on this online.
And I think all of that context is really, really important. So I think in terms of the free float and how that's going to be applied in terms of how much of your index fund will be made up of, say, SpaceX stock or shares is really, really useful and really useful context. And I think ultimately it comes back to what I've said before about the fact these are products that need to be profitable in order to, you know, bring in new customers or new retail investors, right? If by doing anything here, you know, one may argue it results in a loss of return, then clearly they're going to have a problem selling these products in the future, right? So there is an incentive to make sure they're doing the right thing in that respect. But equally, as I say, I'm not surprised here that, you know, this isn't the first time something like this has happened, right? Because, as I say, these dynamics I've described, whereby you have that influence and that closeness between the very wealthy, you know, business owners and legislators, will mean that we're going to see things like this now. We will have seen things like this in the past, and we're probably going to see more and more of this type of thing in the future, actually. It's just a reflection of human nature in many ways, and the nature of the fact that, as I say, at the very, very top financially, you are very, very close to those that make the rules, and you can influence those that make the rules. And in some ways, that is where corruption and collusion happens, right? And again, we just have to think about, you know, the trading decisions that were made just before Trump's announcement. This is just another symptom of those types of arrangements and those types of relationships at that level of society, ultimately. So I hope you're enjoying the video, and please feel free to leave a comment, because it's always good to hear different perspective on the topics we talk about here, and it's the way we learn. Otherwise, if you are new to the channel, please feel free to like and subscribe. In the meantime, if you are worried about your personal finances, the amount of tax you or your business is paying, or you're in a quandary around how you can scale your business by leveraging financing and accounting automation, please feel free to reach out to myself for a no obligation consultation. Otherwise, let's get back to the video.
So rule changes for big companies by these index providers are nothing new. And index investing still work through them. I think the obvious question that we need to answer here is, why are they doing this?
So he came to ask you for advice about whether they should put that into the index early?
Well, she was telling me about the different indexes, but she was also hoping that they would list on the New York Stock Exchange, and they chose the NASDAQ. I think they've chosen NASDAQ.
That's a clip from a CNBC interview with early SpaceX investor Ron Barron, who says the New York Stock Exchange asked him how they could persuade SpaceX to list with them. In the same way that these index providers are businesses fighting for relevance, so are stock exchanges. And sometimes stock exchanges are also index providers. So NASDAQ is a really good example of this.
Now, this is clearly a conflict of interest, but what it should also tell us actually is that where you have this massive wealth inequality, it only means this kind of thing is going to be more and more common, right? Whereby the power shifts from the business having to satisfy the exchange's requirements and the regulators' requirements to actually they are now trying to basically win over the business, right? So you've got all these different exchanges trying to, compete for the business to list with them. And again, when you think about the wider downstream impact that may have on the retail investor, is that a good thing, right? Coming back to the point he raised around the seasoning period, for example, and the fact that, they haven't even bothered to prepare a sensible and professional prospectus. He noted the grammatical errors in there, and the sort of fairy tale type ambitions of the company, and the ridiculous price to sales ratio relative to industry benchmark, right? So again, that is why these wider conversations that have been had about wealth inequality and this massive wealth that is being created and centralized through a handful of individuals is really important, because not only does it manifest in terms of this political dichotomy between the haves and have-nots in terms of who is heard and who is not, and who politicians care about and who they don't care about. We also see this as well in terms of how businesses are treated by those that should be regulating them, right? And those that should be doing a lot of due diligence before allowing them to list on their exchanges, and before allowing them to be part of funds that they're then selling on to the public and or retail investors, right? So that's why all of this stuff is really important to me.
The interviewer asks quite directly, has NASDAQ promised SpaceX quicker access into the indexes as part of winning the listing for its exchange? Now, NASDAQ aren't going to put it like this, and I can't prove intent, but my reading of that clip hints at a possible conflict of interest, or at least an incentive problem. If you are both the exchange and the index provider, you can attract listings to your exchange by changing the rules of what you count as the market.
Exactly. And I think that conflict is important to point out, right? So you can make of that information what you will. The point is that you're aware of that information, and it should be something that's factored into your decision making when considering buying a stock at the IPO stage, and or whether or not you're considering an index fund, right? You've got to understand the rules of how they include certain shares in their exchanges and how they include certain shares in the fund they're selling to you.
NASDAQ could rightfully point out that the NASDAQ 100 is a tech-heavy index that is invested in by people who want tech-heavy exposure. SpaceX arguably fits into that world perfectly. Plenty of investors out there are going to want access to businesses like this and Anthropic. So NASDAQ may see itself as the natural place to offer that exposure, while using free float rules to limit the weighting and the impact that it has on the index overall. So people get what they want, but they're not overexposed to it initially. Okay, what about the others though? What about the FTSE Russell example? Why are they doing this? I don't know their motivation, so this is speculation. I'll say allegedly because I think that gets me off the hook somehow. Clearly it probably wouldn't. But I suspect they worry that if their funds do not include companies like SpaceX, some investors may move to funds that do. Again, it comes back to relevance and competition, doesn't it? The official view on the document that relates to the Russell indexes is that this helps them be more closely representative of the US equity market. And maybe they have a point. Are you actually tracking the market if you miss out on companies like this, of this scale?
And that's a really good point, and it's really one to ponder, but my answer would be no, you're not. But I think that is why, if you're going to include a company, knowing that the retailers are what we describe as, the retail investor are what we would describe as passive, then it needs to follow all the relevant due diligence steps, such as the seasoning period, right? There needs to be consistency where possible around inclusion and the time of inclusion and the requirements that need to be met. So yes, if they're in and they're part of the market, and arguably they're making up 60% of the market, and it is tech heavy, and somebody is choosing to buy that particular index fund, then in some ways you have no choice but to include them. Otherwise, it's not what you're saying it is, right? It's not representative of the market. But I think it also relies on the rules being followed in very simple terms. And I think it's reasonable that an unsophisticated, and I say that respectfully compared to, let's say, a professional seasoned trader, but an unsophisticated passive investor should be able to rely on that. So what shouldn't be happening, as Damien has mentioned, is that he's digging through the weeds as somebody that has a massive holding, actually, based on what he said, to understand, okay, what is actually in the index funds he's investing in, right? That shouldn't be happening, in my view. There needs to be more transparency around all of that stuff.
I'm not here to create sympathy for these index providers, but I imagine right now they're under a lot of pressure to get this right. These companies are so high profile, so popular, so monitored. Add them into the index early and you'll get blamed if they crash back down to earth. Whereas if you wait, you'll get blamed for missing out if they go to the moon.
I agree with him. It is a damned if you do, damned if you don't situation, for sure. And I think for me, my view would be, if they're in and they're representative of the market generally, then you kind of have no choice but to include them in the product you're offering. However, you do need to make sure that there's appropriate protections in place for passive retail investors, by at least, at the very minimum, making sure rules are being applied consistently, and certainly that there is a seasoning period. For me, that is something personally I would have liked to have seen applied more consistently.
At the same time, index providers are scrambling around chasing relevancy and listings in a competitive market where there are trillions at stake, changing their own rules to accommodate these mega IPOs. All of that is true. But it's also true that a lot of the chat around this that's calling it out as just nothing but terrible is lacking some of the specific details. Yes, there is an impact, and everyone is doing the right thing by shining a light on it. I think, there's good journalism going on out there. But that light should include things like the fact that the NASDAQ 100 index rule changes around the free float that limits it below 33%, they're actually improving an old rule that really wasn't good for investors before. There's also not enough discussion that highlights this has happened before. It's not every index. It's not all happening at once. And where it is happening, there are structural components, namely the free float rules, that mean the size of this impact is limited for now.
Yeah, and I think he's right. And this is why I actually like this particular content creator, because he's always very balanced. He always gives a lot of context. And I think for me, that is something I personally really, really value, because he is right. In my own algorithmic bubble, the way this was being reported, obviously much of it is clickbaity, and that is the job of a content creator. That's not a criticism, but it made it sound as though, we were going to have this massive exposure to this stock. But if it's restricted by virtue of this free float formula, that means, only a fraction of the available stock is taken into account, and therefore that is mirrored in terms of the makeup of the index fund, then in many ways, yes, you have exposure to it, but it's a very fractional and very small exposure, which is the whole point of the index fund. The whole point of it, as I mentioned at the beginning, is that you have this very generalized and perceived to be safe exposure to many, many different things. And if it just so happens that the market is a bubble, because 60% of all stocks on the market are AI related, it just is what it is, right? The key thing is that you're making these decisions in an informed way. And from my own personal perspective, inclusion in the product, inclusion on the market, inclusion in the exchange is applied consistently, right, to protect the consumer. That's for me the main caveats I would have on a personal level.
For me, while I won't change the funds I invest in for now, and some of the funds I invest in are affected, I'm going to see how this goes down with SpaceX across that fund range that I have. And if I think my fund providers have handled this poorly, I'll consider my options ahead of the further mega IPO launches that look like they will happen. But my view on this today really is, I want stability and predictability from my index provider. I'm not here chasing the performance of individual stocks. If I was, I wouldn't be buying the index, right? I'd buy the stock. I want broad exposure to the market long term. I concede that, at the point SpaceX lists on the stock market, it is part of the market. So if I want broad market exposure, I should be after that. But I'm personally happy to miss out on the next hot stock, just so that it can prove itself on the market a little bit before it enters my index, especially when I think it's massively overvalued.
And again, that's essentially what I'm saying. And I do agree with that feeling, right? I want to see it being tested in the market first. So although he's calling out the accounts here, and to give you some context, that's like 18 billion. versus, like I say, the value, I can't remember, it was 2 trillion or something else, but you know, even if it's 2 trillion, right? Clearly they're very, very different numbers. But in many ways, you know, when you value a company, much of it is taken into account, you know, intangible things like the addressable market, which he talked about, first mover advantage, and certainly if it's a market that is untapped, right? Nobody else is servicing that market, right? Nobody else, as far as I'm aware, is looking to colonize Mars, right? Whether we believe that's actually going to happen or not is a completely different question. So I guess the point is that, you know, we can only speculate about this valuation, right? You know, the numbers will tell us some things, but we can only speculate. And ultimately, that is why the seasoning period is really, really important. And I think for me, that is why I agree with him that it would have been good to see that seasoning period to substantiate whatever it is SpaceX is saying, right? And then we'll find out if we're right or wrong on that point.
Just my opinion, of course. If Elon's SpaceX gets you macro hard, you do you.
Yeah, so really fantastic video by Damien Talks. I will leave a link to the original there and definitely check it out for yourself. And as I say, you know, he is somebody I do respect. And if you are minded to do so, certainly comment, you know, follow and subscribe his channel. As I say, it offers a lot of value. You know, most of the content I've observed of his has certainly added a lot of value to me personally. And as I said, I would recommend, if you want to get into the details regarding the concerns around the IPO itself, definitely check out Patrick Boyle's video, which I've mentioned a few times now. But it is a very, very good video. And again, I'll leave a link in the comments for that as well. But yeah, I think, again, this was a really useful video, just because, as I say, I know the SpaceX IPO has definitely got a lot of people excited as well as concerned. And I think it's important that if you are considering, you know, taking part in that IPO, like any investment decision or opportunity, you just do your due diligence, as Damien has clearly done here, right? So it's not to suggest that you shouldn't consider it, and it's not to suggest that you should consider it, right? All this video is doing is just informing and giving wider context as to, you know, what should be considered. And what we should potentially be concerned about, right? And that is why he's calling out the index fund providers. He's calling out the relationship and the conflicts that exist between the exchange and the fact that they're also selling a fund. And in my view, there is this wider connection in terms of the influence and the closeness that these wealthy, you know, these ultra wealthy individuals have with the regulator and those that run these exchanges, and Donald Trump specifically, right? So, as I say, it would be interesting to hear your comments and your thoughts. But until next time, take care. Peace.